Hey, what's up, everybody? It is Monday, April 21st, and I hope you had a nice Easter. So we're back at it. Market down today, big down, big down. And a lot of this was blamed on Trump, the Trump Powell feud. Trump coming down hard again on Powell. He wants him out, and I'll talk about that in a second. I don't think the market's problems, if you want to call it that, is completely based on this Trump Powell situation, although I understand those headlines, they trigger people. You have the monetarist zombies. They're afraid that if Trump gets rid of Powell, Trump's going to put somebody in there who's going to cut interest rates, and they're selling the dollar. I'm going to talk about that too. I actually think that the problem right now is more of a fundamental economic problem. I don't know if I mentioned this last week. I don't think I did because the data became available on Friday. But there has been a very, very significant surge. I have to use that term, a surge in tax drain that just recently happened. Let me give you some perspective. Back in December, mid-December last year, the federal government was collecting $48 billion less in individual income taxes compared to the previous December. So like in December 2024, the government was collecting $48 billion less in individual income taxes compared to December 2023. All of a sudden, that was the case, that's been the case, that the government has been collecting less in individual income taxes. So you could think of that as a kind of a quasi, not even a quasi, but an actual fiscal stimulus, because it's taking away less. All of a sudden, now, since last week, that tax haul, that tax drain is now positive 80 billion. So it went from 48 billion less year over year last December to now 80 billion over last year. So that's what, almost like a 130 billion drain from the non-government's financial balances, our financial balances. That has been, if you look at it graphically, I mean, it's literally, it goes like this, and it literally just jumps up like that. It wasn't even gradual. It just happened. A massive, massive tax drain. And this is not because it's tax season, because I do a comparison year over year. It was tax season at this time last year, so that eliminates the seasonality aspect. So something happened. Maybe it's the expiration of some of these IRS tax extensions. I know I got one coming up on May 1st. That's another thing. There's going to be another big drain on May 1st. And I think California had an extension too. I think that might be in October, but we'll deal with that when we come to it. So this drain, to me, even though leading fiscal flows are very, very strong, they're very strong, okay? The net flows, right? That's the water in the swimming pool. I mean, you might have that water coming out of the pipe really, really fast in a huge volume. That's the leading flow. But the level of the water is sinking. And suddenly, in the last week, it dropped significantly, okay? It wasn't like a teeny tiny imperceptible drop that you couldn't see. The water, you went out in your backyard to look at the pool and like, oh man, it's below the skimmer level now. You see what I'm saying? So this has implications for the economy. And I am now saying, I'm going to go on record, that I think the probability of a recession is very high right now. And if that's the case, the stock market has a lot farther to go on the downside, all right? Because the next thing we're going to see, if I'm right, if this keeps up the way it's keeping up with this mega drain, the next thing we're going to start to see is a sharp increase in layoffs, job losses. That's the next thing we're going to see, okay? So it's a problem. Now, we've seen in the last 5 days 363 billion of tax drain in the last 5 days. I said in one of my prior videos, we're going to see something. We're going to end up seeing something like 371, 375, maybe more than that, because that was last year, 371 billion drain in the April period. We're maybe going to see a little bit more than that. So I think we're getting close to the end of this particular drain, you know, the April 15th, so to speak, drain, which means we should get a temporary short-term bottom in the stock market. I actually did some buying today. I actually also went long the dollar a little bit. I'm going to talk about the dollar. But this is temporary, man, because May 1st, we're going to get another drain. Now, let me mention the dollar. Today's dollar action was connected again to these monetarist hysterical monetarist zombies who were selling the dollar hand over fist because of the headlines about Trump wanting to get rid of Powell. And they believe that if Trump gets rid of Powell, he's going to install somebody who's going to cut interest rates, and that's going to be negative. The ECB, have you been watching the euro lately? The euro is shooting through the sky. The ECB has cut rates 7 times and the euro is going up, okay? Same with the British pound, although the Bank of England didn't cut 7 times, and these other currencies. The United States right now, under Jerome Powell at the Fed, is actually running like almost a 9% real interest rate. When you look at the producer price index, was like a negative 0.4, and he's got the rate at like, 4.5%. You're talking about a 9% real interest rate, okay? A 9% real interest rate. How is that helping the dollar? That is hurting the dollar. Let me ask you something. How did high interest rates help the Argentine peso? How did high interest rates help the Turkish lira? Every time those countries raised interest rates, what happened to their currencies? They went down and down and down. Same thing, we see that all over the place with monetary policy. But these people continue to do the same thing over and over again. How is inflation falling in the euro area when the ECB cut rates 7 times? Very simple, because of what I say. A rate cut equals a price cut. The cost of credit is reflected in the cost of all goods and services. Powell is sitting there, and I agree with Trump that policy has to change. I agree from the standpoint that if you want to have lower inflation, you must cut interest rates, okay? I think personally, I know many of you disagree with me, I think it's very bad that Powell is digging in his heel. You have the President of the United States who selected you, okay, and put you in that post. And he's now unhappy with the job you are doing. And he's been coming out publicly saying that. Maybe many people disagree with his methods, but that's Trump. He does not want you. The honorable thing to do is to resign. A secure person would not be offended, would resign and walk away, because that is the thing to do. You are not wanted in that post anymore. But what Powell is doing, digging in his heels, stubborn, petty, vindictive, and he has a whole universe of people supporting him for reasons they don't even understand. They're still arguing that we need him in there to protect, like, the dollar. How is the dollar being protected with his policies right now? The dollar is getting smashed, even though the United States right now is running some of the highest real interest rates in the world. He does not understand the monetary system. And that's not completely his fault, because the entire establishment of economics doesn't understand it in the way that it actually functions. And he's a member of that establishment. But it is very bad that he's digging in his heels in this stubborn, petty, vindictive manner. He needs to go. That's not to say that necessarily low interest rates are going to solve any problems. The problem right now is massive tax drain, which is lowering the swimming pool, reducing the balances in the non-government. That is the problem. And I don't know what this new budget is going to come out with. I don't know if it's a net spending reduction, if it's a net spending increase. I know it's going to include tax cuts, the extension of the 2017 Trump tax cuts, but we're operating under those tax cuts right now. It's not like we're getting new tax cuts on top of that. That's just institutionalizing or setting in place what we already have. So I don't know. All I can tell you is that I feel right now that the risk of a recession has increased dramatically as a result of this spike in tax drains, the reduction in net government transfers. And I mean, I'm just waiting for the next shoe to drop. And that next shoe to drop for me, which would solidify in my mind the fact that we're going into a recession, that would be a sudden rise in layoffs, job losses. So I'm watching the data. I'm waiting to see that. But at the very least, at the very most, I should say, all we're going to get is a short-term bounce in stocks. And the environment right now is not a positive one. Let me talk a little bit about bonds, which had another, I wouldn't say it was a rough day. I would say a disappointing day, although the 2-year yield was lower. The 10-year yield was higher a little bit by 8 basis points, and the 30-year yield was higher. When I'm looking at what's going on in the dollar with this panic selling of the dollar, and when I'm looking at all this panic selling as a result of the so-called feud between Powell and Trump, I have to say that the bonds are holding in there okay. Not spectacular. I would think they should be going up at a time like this, but if I'm right, and if there is a recession, then the Fed's going to have to start cutting rates. But right now, there's pressure. There's pressure from dollar selling. There's pressure from headlines. There's pressure from a story, so to speak, going around about everybody wants to get out of America, the economy, that is. And so this is understandably created an environment where you get a lot of selling. And I see that like in futures commitments and stuff like that. By the way, I also see when I did my banking data for the week ending April 9th, that was the latest, banks been steadily buying treasuries. They're holding a record amount of treasuries. They've been adding over the last 2 weeks when we have seen this sell-off occur. Okay, so it's a lot of speculative activity. I don't know how much of it is actually foreign or what, but I have to say that even though it was a negative day for bonds, given what we saw in the dollar, I mean, they held up okay. I don't know how much longer that's going to be the case. I mean, if the Fed keeps pushing on this hawkish view, and again, by the way, my sentiments were echoed online in a number of posts that I saw. Maybe people are reading my stuff clandestinely. I don't know. But I said to you guys that the Powell, what was it? Not last week, the Friday before or something, when he had that talk at the I think it was at the Economics Club of New York or the Economics Club of Chicago, when he had that talk and he said, you know, we got to be hawkish because we think this is going to happen. And I said, he shouldn't be projecting expectations. The Fed should be there to react to conditions. That's why it was created. And I said that he was creating all this needless uncertainty by giving his forecasts. Nobody's asking him to give his forecasts. That's not what the Fed should be doing. There are forecasting firms out there. That's what they're that's what they do. But Powell should not be up there giving his forecast because he's frankly not very good at it. And that's not what he should be doing as the guy who runs the Fed. If anything, if he's going to say anything, instill some confidence, saying that we're going to monitor the data, and if we have to react to conditions, we will. And that's a very bland general statement, which would be fine. But don't say like, hey, we're worried about inflation, and just pump that up and pump that up and pump that up. I mean, that is very, very irresponsible. And I saw a number of articles and a number of posts online which echoed, in fact, some of the words that I used were almost exactly the same. So I'm wondering, maybe some of these people are clandestinely reading my stuff. Anyway, that's it for today, folks. Please like and subscribe. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. Bye.